Welcome back to the Entrepreneur's Compass. Today, Olivia and I are tackling a topic that literally keeps founders up at night. To bootstrap or to raise capital, it's arguably one of the most fundamental decisions you'll make when starting or growing a business.
Oh, absolutely, Mark. It's not just a financial decision, is it? It's deeply personal, impacts your control, your vision, even the very culture of your company. I mean, do you want to be the sole captain steering your ship? Or do you invite a crew of co-captains with a shared interest in getting to port faster?
Exactly. Let's start with bootstrapping because I think for many, that's where the entrepreneurial journey naturally begins. You have an idea, maybe a little savings, and you just start building, selling, iterating. It's about using your own resources, revenue from sales, maybe a small loan from a friend or family, to fund your growth.
Yeah, it's the lean and mean approach. I remember when I first started my consulting business, there was no thought of investors. It was just me, my laptop, and a burning desire to not go back to my old job. Every single dollar I earned went right back into the business, whether it was for a new software subscription or a coffee meeting with a potential client. It forces you to be incredibly resourceful.
That resourcefulness is one of the biggest upsides. When you bootstrap, you're forced to focus on profitability from day one. There's no runway of investor cash to burn through. Every expense is scrutinized, every sale is celebrated. That instills a discipline that can be incredibly valuable long-term.
And the control. Oh my goodness, the control is unparalleled. You don't have board meetings, you don't have investors questioning your every move, asking for quarterly reports on metrics that might not even align with your core vision. You get to make all the decisions, pivot when you need to, and truly build the company you envision.
That's a huge point. Retaining 100% equity means that if your business becomes successful, you get 100% of that success. It's yours. You built it, you own it. It allows for a slower, more organic growth, which isn't always a bad thing, especially for certain types of businesses.
True. Think about lifestyle businesses, or even a lot of agencies. They don't necessarily need to scale to unicorn status. They need to be profitable, sustainable, and provide a great living for the founders and employees. Bootstrapping is often the perfect model for that.
But let's be honest, bootstrapping isn't all sunshine and rainbows. There are significant challenges. The most obvious one is often the pace of growth. Without significant capital, scaling can be much, much slower. You might miss out on market opportunities because you simply don't have the resources to move fast enough.
And the personal sacrifice, my goodness. You're often pouring your own savings, working insane hours, taking on all the risk yourself. I know so many bootstrapped founders who didn't pay themselves a salary for years, lived off ramen noodles, and were constantly worried about making payroll. It's incredibly stressful, and burnout is a very real threat.
Definitely. It can limit your hiring capabilities too. If you can't offer competitive salaries or benefits from day one, attracting top talent becomes a challenge. You might end up doing everything yourself, from sales to customer support to product development, which is just unsustainable in the long run.
So that brings us to the other side of the coin, taking on investors. This is often seen as the glamorous path, right? Shark Tank, venture capitalists, big funding rounds. What's the initial appeal, Mark?
The initial appeal is simple: capital. A significant injection of cash can accelerate everything. You can hire more people, invest in marketing, develop your product faster, expand into new markets. It's about speeding up the trajectory of your business significantly.
It's like hitting the turbo button. Instead of incrementally building your user base, you can launch a huge marketing campaign. Instead of waiting months for a feature, you can hire a whole dev team and get it out in weeks. It can be a game changer for businesses in competitive, fast-moving industries.
Beyond just the money, good investors bring a lot to the table. They bring expertise, mentorship, and a network. Imagine having a seasoned entrepreneur or a venture capitalist who's seen hundreds of companies scale, advising you. That's invaluable. They can open doors to partnerships, future funding rounds, or key hires that you wouldn't access otherwise.
Absolutely. It also lends credibility. When a reputable VC firm or angel investor backs your company, it sends a strong signal to the market, to potential customers, and to other talent that you're a serious player. It can make it easier to raise subsequent rounds or even secure large enterprise deals.
And it can reduce the personal financial risk for the founders. You're not necessarily putting your house on the line anymore. The money comes from the investors, allowing founders to potentially draw a salary earlier and focus more on strategic growth rather than just survival.
However, and this is a big however, it comes at a cost. The most obvious one is equity dilution. You're giving up a piece of your company, and sometimes a significant piece, in exchange for that capital. This means you own less of the pie, even if the pie becomes much, much larger.
And with that dilution often comes a loss of control. Investors, especially VCs, aren't just passive money providers. They typically want a say in major decisions, often taking board seats. They have a fiduciary duty to their own limited partners, which means they're looking for a specific type of return on their investment, usually a high-growth, high-exit strategy.
Which can create pressure. Enormous pressure. They're expecting a 10x, 20x return in a relatively short time frame, typically 5 to 7 years. That means you're constantly chasing aggressive growth targets, sometimes at the expense of profitability or even the product vision you initially had. It can feel like you're on a treadmill that keeps speeding up.
And if things don't go as planned, the relationship with your investors can become strained. They might push for changes in leadership, strategy, or even force a sale of the company that you might not agree with. You're no longer just accountable to yourself or your customers, you're accountable to your investors and their expectations.
It can also be a massive distraction. The fundraising process itself is incredibly time-consuming. Preparing pitch decks, having endless meetings, due diligence, it can take months, pulling you away from actually running and growing your business. And it's not guaranteed. You can spend all that time and come up empty-handed.
So, how do you decide? It's not a one-size-fits-all answer. I think the first thing to consider is your business model. Are you building a software-as-a-service company with high upfront development costs and recurring revenue potential, or are you opening a local coffee shop? The funding needs and growth trajectories are vastly different.
Exactly. If you're building something that requires significant R&D, patenting, or needs to capture a market very quickly before competitors emerge, then external investment might be essential. Think biotech, deep tech, or even rapidly scaling e-commerce platforms. But if you're offering a service that can generate revenue from day one with minimal overhead, bootstrapping makes a lot more sense.
Then there are your personal goals. Do you want to build a generational business that you own outright and pass down? Or are you aiming for a massive exit in a few years, even if it means giving up a lot of equity and control along the way? Your personal ambition plays a huge role.
And the market you're in, is it a winner-take-all market where speed is everything? Or is it a niche where sustained, steady growth can lead to a very healthy, profitable business over time? The competitive landscape absolutely dictates how much urgency you need to inject into your growth.
What about the team? If you have a rock-star team with a proven track record, raising money might be easier and make more sense because you're seen as a lower risk. If you're a first-time founder, bootstrapping to prove your concept and gain traction before seeking investment might be the smarter play.
I often tell founders to bootstrap as long as humanly possible, even if they eventually plan to raise. Why? Because the more traction, revenue, and product development you achieve on your own, the stronger your negotiating position will be when you do talk to investors. You'll give up less equity for more money, and you'll have a clearer valuation.
That's excellent advice. Bootstrapping to product market fit or even early revenue gives you so much leverage. It shows commitment and ingenuity. And sometimes, you might even realize you don't need external investment. You might find your profitable niche and be perfectly content.
It's also about knowing what kind of investors you're dealing with. Not all money is created equal. Are they strategic investors who bring industry connections and expertise? Or are they purely financial, looking only at the numbers? Understanding their motives and what they expect is crucial.
That's a key distinction. A good investor is like a partner, not just a bank. They should be aligned with your long-term vision, even if their timeline is a bit shorter. You want someone who adds value beyond just the check they write.
And the due diligence goes both ways. You should be interviewing them as much as they're interviewing you. Talk to other founders they've invested in. What was their experience like? Were they supportive during tough times? Did they meddle too much? This is a long-term relationship you're entering into.
It's almost like a marriage, isn't it? You want someone who understands your quirks, supports your vision, and is there through thick and thin. Getting the wrong investor can be worse than no investor at all.
Exactly. I've seen situations where founders were so desperate for funding, they took money from the first person who offered, without truly vetting them, and it ended up being a nightmare, losing control, getting pushed into directions they didn't want to go.
So to summarize, bootstrapping offers maximum control, higher equity retention, and forces early profitability, but at the cost of potentially slower growth and higher personal risk. Taking on investors offers accelerated growth, access to capital and networks, and reduced personal financial risk, but at the cost of equity dilution, loss of control, and immense pressure.
And ultimately, it comes down to what kind of journey you want to have and what kind of business you're building. There's no shame in either path. Both have led to incredible successes. The key is to be intentional, understand the trade-offs, and choose the path that aligns best with your vision, your personality, and your business's needs.
Couldn't have said it better myself, Olivia. It's about making an informed decision, not just following the crowd. Whether you're grinding it out on your own or scaling rapidly with investor backing, stay true to your mission.
That's all for this episode of The Entrepreneur's Compass. Thanks for joining us, and we hope this helps you navigate your own entrepreneurial journey. See you next time.